the way we transitioned into actually raising money was very unique, right? Because typically what people do is they, eventually leave their job. They go approach a lot of VC firms or angel investors and pitch to hundreds of people. The strategy we had was, why don't we first, instead of creating 100 shallow relationships and hoping one of those click, why don't we try to choose one relationship, go very deep with that relationship, and once we build out a proof of concept, once they see us grow and understand our growth and who we are as people, approach that person for money.
This is episode number 48 of the Short-Term Rental Success Stories podcast. Are you an investor that's looking to have your home professionally managed? Go to cohostit.com for more information. Welcome back to Short-Term Rental Success Stories. I'm your host, Julian Sage. This is a show where I talk to hosts about their journeys in starting and growing their short-term rental business. My goal is that you'll be able to walk away with practical information that'll help you become a better host and learn how to scale your business. Like any exceptional host, we all strive for 5-star reviews, so please go on over to iTunes and let us know what you enjoy, as it really helps support the show. If you haven't done so already, go on over to our Facebook group, The Host Nation, to connect with the community. Hey, what is going on, Host Nation? I am super excited to be back again with you this week. Wanted to highlight a special review that came in from JP Gray, and they said, 5 stars, fantastic. Very helpful info. I love hearing all the different ways people are becoming successful through short-term rentals. Thank you so much, JP, for the review. I really appreciate when you guys leave reviews for us. If you'd like to leave a review for the podcast, then go to shorttermsage.com/STR review, and you can leave us something which we will feature on the next episode. One of the goals for this year is to become the #1 rated podcast. So we are now the #1 and 2 podcasts on iTunes for Airbnb, but it'd be really nice to be the most highly reviewed. So if we can make that happen, host family, that would be awesome. A couple of really exciting things. I know you all have been asking for when the B&B Empire Builders group is going to open up again, and it will be opening back up in March. We've got a lot of applications from so many of you, and I'm really excited to really focus on scaling. Scaling is something that is not talked about a lot in the short-term rental space. A lot of it is just on operations, and operations are important. But if you are trying to build your B&B empires, we want to be the platform for you guys to be able to grow your businesses. If you'd like more information on the B&B Empire Builders, if you'd like to fill out an application, then go to shorttermsage.com, and on the homepage, you can find where we are accepting applications. Another really exciting piece of news is that we are going to be opening up the Vrm Formula. So if you are interested in starting, automating, and scaling your own vacation rental machine Airbnb business, we are going to be opening up the program in March. This is going to be for our early adopters, really. So if you are interested in becoming an early adopter for it, then you can get in for the early bird price. Go to shorttermsage.com/earlybird, and you can join the wait list for when that does go live. When we do release that, it will be for initially the people that are interested in getting early access to that. When we do decide to open it up to the public, though, we will be increasing the price. It's something that John and I have been working on for a long time now, and I'm really excited that everything's kind of coming together. We have a lot of lofty goals, but becoming just a really just the foundation for your business to be able to give you all the tools that you need to be able to succeed in this business. After talking with over 50 hosts now, working with John one-on-one for all these months, starting our own management company, and just really diving in and figuring out how can we take this business, break it down into its simplest forms, and then be able to repackage it in a way so that other people can just take it and then start and grow and scale. That's something that I've been really passionate about, and I love just being able to take all this information and find the best way for you, creating all these really cool tools that we have, things like our rental arbitrage and co-hosting calculator, updating all of our forms and check-in processes and ways that you can scale a co-hosting and rental arbitrage business. There's just so much that we are going to be including that I don't want to spoil the surprise, but there is just so much. And last note, if you are interested in investing with us, Co-Hostit is taking on properties for March. We do have quite a few properties that we are going to be picking up. So if you'd like to join and you are interested in investing in our turnkey rental arbitrage program, then go to cohostit.com. The returns that we're able to bring in for our investors is just wild. So if you are interested in investing into something passively and getting into the rental arbitrage space without having to do any of the management yourself, then go to cohostit.com, fill out an application, and we would love to be able to speak with you more about that. So lots of exciting stuff happening in the space. And one of the things that is really exciting is all of the new people that are coming in and coming up with these really creative ideas of taking something that, the traditional real estate model, which was very slow, hasn't changed for very many years. And now we have people like our special guest, Shiv Gettu. Shiv recently graduated from the University of California and fell into real estate and short-term rentals by chance. He and his business partner, Kendrick, had their first unit back in January of 2019. In the span of 14 months, they've scaled up to 32 properties, 25 in which are rental arbitrage and 7 are co-hosted units. Now, Shiv is actually a really unique guy. I met him at the Bigger Pockets conference back in Tennessee this year, and he is just a beast. He is like 7 foot tall, real young guy, and he really just looked like a kid that just graduated from college. But man, this guy is rocking and rolling. And when Shiv told me about his story, about how he got into the space and how he was actually venture-backed other people to invest capital into his rental arbitrage business, the first thing that I had in mind was like, why would you do that? But the second was like, how did you do that? And I really couldn't understand why he decided to go venture-backed route until I spoke with him on this show. In this episode, Shiv shares how they got started in their short-term rental business, what they did to be able to raise capital to be able to start this business, and the opportunity that they found in the multifamily and short-term rental syndication space. This is an episode I have just been waiting for because syndication has been something that I've always thought about, but to see somebody actually going after it is just so cool. Shiv also shares the importance of setting up systems and utilizing technology to run your business effectively. Shiv is a very Silicon Valley startup type of guy, so you'll hear this in this episode. If you'd like more information on this episode or any of the show notes, go to shorttermsage.com/STR48, or if you like my show notes sent directly to your inbox every week, then go to shorttermsage.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, Host Nation, to another episode of Short-Term Rental Success Stories. In this episode, I have the special honor of speaking with Shiv Gettu. Shiv, would you please introduce yourself to the Host Nation and let them know who you are and what inspired you to get into short-term rentals?
Sure, Julian. Thanks for having me. My name is Shiv Gettu. I am a 24-year-old recent graduate from the University of Southern California. I studied engineering, and I kind of fell into real estate and Airbnb by chance. I'm from the Bay Area, so I lived when I moved back, I decided to live in my parents' house to save money on rent. They actually aren't located here. They moved to India and they built kind of this granny unit that they used to come back and forth. So I was kind of acting as the property manager. I kind of fell into real estate, helping them manage their unit, started exploring different alternatives for tenants, found this company that does this, where they rent out properties from you, and then they kind of room for rent each unit. And I kind of just got exposed to being creative in real estate and started brainstorming. And came across short-term rentals and was thinking about doing some buy and hold. But after a few transitions, decided that Airbnb was probably the best thing that I wanted to do at this point in time.
And just to give a little bit of pre-context, you have a management company that does primarily rental arbitrage. You're at 32 properties right now. You have a co-founder, and what's also pretty interesting is that you're VC venture capital backed. So you had some investors that helped you to get started, I guess. Do you mind kind of explaining how that kind of transition from you graduating, kind of figuring what you wanted to do, to now you have 32 properties a year later and this big company?
Yeah. So it's a long story, but I think the way it starts is I always was kind of unsettled with the idea of having one source of income. I mean, I'm sure most of your guests talk about this, but it didn't really seem like the most smart thing to do when people talk about job security and relying on one source of income. I wanted kind of that flexibility to transition to something else if I wanted to. And the best way to do that in my mind at that point in time was real estate, right? So I was looking at I'm from the Bay Area. I live in the Bay Area. Obviously, things are very difficult to cash flow here when you're buying. So we thought about buying and doing some buy and hold in the Southeast. So we were looking at markets in Atlanta, in Nashville. And when I was looking at the deals, we found some good properties. They would appreciate a little bit, but they'd cash flow a few $100s. And I was like, okay, how long is this going to take for me to actually, raise money or save up enough money to buy these properties and then have it eventually replace my W-2. And it didn't necessarily seem like the fastest way. So I basically spent the first 3 or 4 months as like an incubator, just learning, reading, podcasting, everything I could get my hands on. And I came across this article by Paul Moore, who's actually a good friend of ours now. He's a multifamily guy transitioning into storage. So he wrote this article about this guy called Jay Martin, who's also a friend of ours, who basically travels the world and has 20 properties on Airbnb, which his team is managing, and it's all passive, and he's working 4 hours a week and earning, 7 figures or 6 figures. And we were just like, wow, this seems ridiculous. I mean, he doesn't even own the properties. He's renting and re-renting, right? So we kind of got creative. I reached out to everyone I knew, started networking with, my parents are from here, so started asking them if they knew about anyone from who did real estate, and eventually got connected with a landlord who owns quite a bit of real estate here. We kind of pitched our idea, and he let us trial out our rental arbitrage idea on some of his units. So we signed a lease with him. We each invested 7,000. So my business partner Kendrick at the time, I was kind of bouncing around the idea of doing this real estate business with him, and he was super down. He was in Boston at the time, and we approached this landlord, pitched this idea, and he was kind of hesitant at first, but he eventually agreed and gave us a few units. But yeah, I mean, that's kind of how we got started, and the way we transitioned into actually raising money was very unique, right? Because typically what people do is they eventually leave their job. They go approach a lot of VC firms or angel investors and pitch to hundreds of people, get hundreds of no's. The strategy we had was, why don't we first, instead of creating 100 shallow relationships and hoping one of those click, i.e. going to a bunch of VCs and a bunch of angels and getting 100 no's and getting one yes, why don't we try to choose one relationship, go very deep with that relationship, and once we build out a proof of concept, once they see us grow and understand our growth and who we are as people, approach that person for money, right? So the strategy was, with this investor, we knew that there was kind of a gap in his business, right? He was very, he was very on top of it. I mean, in the sense that he'd made great purchases, but he was kind of more lackadaisical in his management style and wanted, it wasn't running as efficiently as it could be. And we kind of had ideas. So we approached him, we told him our ideas, and he said, yeah, sure, this sounds interesting, but how are we going to make this work financially? And, we at the time were like, we just want to learn, right? I mean, we had met this guy, he had done so well in real estate. He was a very inspiring guy. And he was kind of taken aback by the fact that we were willing to work for free for him, and spend time and help him out, that he ended up just offering Kendrick, my business partner, the opportunity to just work with him directly. So Kendrick, in a few days, wrapped up his whole life in Boston, moved from Boston to California to work with this investor. And the idea with us was, the closer he can get to this investor, and really understand how his business works, the more opportunity we get to learn, but also the more opportunity we get to build this deep relationship with the real estate investor. And eventually, when the time comes, see if we can further the relationship financially. So that's kind of how we raised money. Long story short.
So you guys, recent graduates, you had a little bit of money in your pocket that you were looking to invest in some real estate, but you saw the market, saw that you're maybe going to make a couple $100s a month based off of market conditions. So you said, hey, well, let's get into the rental arbitrage space. With you and your partner, how did you handle that partner relationship? Because maybe a lot of people that are listening to the show, they might, maybe they don't have the money, but they have a partner that does have some money. But both of you guys had a little bit of money to put into these properties. So how are you delegating tasks?
Yeah. So I think the idea was we first put in $7,000 each, right? The way we delegated it was kind of on skill set. I'm traditionally a lot more logical. I'm very systems driven, processes driven. We're both engineers. He did mechanical engineering. But I think I tend to lean towards more structure and goal oriented and systems building. I'm not necessarily as creative. So Kendrick is more kind of creative and willing to take risks. And I think the dynamic we had was, he would kind of push us to do things, and I would kind of make sure that we're doing it correctly or making sure that we're not missing the ball on anything. So the dynamic we had was he would kind of move us forward, and I would make sure we're moving forward correctly. So from a tactical and strategy standpoint, that's kind of how we moved forward. From a task split, Kendrick was kind of responsible for furnishing and kind of getting it beautified. I was responsible for building our operations and our teams and managing cleaning and pricing and kind of systematizing the whole business, while he focused on business development and sales and building relationships with the landlords, etc.
So you had these couple of properties. How were they performing, and how long was it before that you said, okay, you get to the next point, which was meeting your investor partner?
Yeah, so that's also a good story. So when we decided to take the first unit from the investor, he has a big building in Redwood City, and I was super excited that he said we could take it. The building's a little bit older. So when we decided to go to the building, I was like, okay, I'm ready to sign the lease. I was super excited, and the property manager gave me the paperwork, and I signed the lease, and I was already there, and it was in the evening. I was like, why don't I just spend the night in this apartment? And I didn't have any furniture, didn't have a pillow, but I was like, let me simulate the experience with nothing in there. So I was sleeping in the apartment, and then I suddenly noticed that there was some cockroaches and bugs, and it wasn't necessarily the best unit, especially since we were considering doing corporate rentals, which, Airbnb and corporate, it's all review based and hospitality driven. So that wasn't necessarily the best fit. So unfortunately that unit didn't work out. But we kind of transitioned into finding another building, and getting a unit there. And we started at the worst time, right? We started in December. We had no idea what we were doing. We had no idea of the tools that we could use. And we were losing money. And we were like, why did this seem so easy when it's not? And we're losing a couple $100 a month, right? And this is when we kind of got creative. We started brainstorming and thinking about the different products. Like, what does a hotel offer? They offer just a room, with one bed or two beds. What happens if we're able to put two beds in a bedroom? Right? Will that increase the occupancy, and therefore make it more affordable for people to stay? So we did a little bit of tweaks. We did A/B testing and understood that, if we make these small tweaks, our margins just increase. So we went from, losing a couple $100 a month in December, January, to starting to make a lot more money. Granted, that's partly due to seasonality, but also partly due to the fact that we added a bed, and kind of made it more affordable for more people.
So at this point, you're probably January, February right now. You're losing money, but you made some tweaks. And then at which point did you say, I need to find some additional capital?
Yeah. So, we put in $7,000, which was good enough for us to get started. But we were still trying to, so there are two business models. I'm not sure if your listeners know, but the two business models we work with, we call them asset heavy and asset light. They're different names. Asset heavy is known as master lease, right? Where you sign a lease with an owner, you guarantee them rent, you buy the furniture, you pay them rent, and whatever you make on top of that is yours. The other model, which we call asset light, is when you take a management fee, kind of co-hosting, etc. We were doing asset heavy, so we were signing these leases, which meant that we needed to buy furniture. Once we got a few units going, we had to start raising money, but we didn't necessarily want to sell a piece of our company, so we took debt money, which is basically we took out a loan from friends and family. So we raised some money from friends and family, and told them that we'd pay them a fixed percentage interest rate. And this is our idea. This is what we're doing. This is how the returns have been so far. This is what we're projecting, etc. A lot of them were earning 3-4% in a bank. We offered them, 8 to 12%, which was a huge jump. So people were interested, and that kind of got us to 15 units. So we did that for 15 units. So we raised, I think, maybe 80 grand, 90 grand through this technique. And that's when we decided, okay, well, maybe it's better to just get equity money and sell a piece of our company in.
So you scaled up to 15 units. How long did it take to get to 15 units after you started sourcing money?
Yeah, so our first unit was in January 2019. by March 2019, we had one unit still, or two units. It was like kind of that, when you look at hockey stick growth, it was like that flat horizontal. And then in April, we just suddenly went from like, I think one unit to like 5 units. In May, we were at like 10 units. And then like by August, we were at like July or August, we were at 15 units. So in these 3 or 4 months, we just kind of like built this whole system and process, and then just did rinse and repeat and just scaled really fast. And that's when we kind of approached and raised this venture angel money.
Where were you getting all of these units from? Was it from the same manager investor or?
No. Yeah. So we took a few more from him, but we didn't want to necessarily put all our eggs in one basket. We also wanted to build out proof of concept that we can do this in any situation. So what we did is we kind of built a very strong sales cycle. So by this time, we hired our first virtual assistant in February of 2019. And we kind of noticed that she was very good on the phone. So the sales cycle we set up was we had her generate leads. So we'd scrape all the Craigslist and the Zillows and the Zumper and all of that, get all the places that were looking to find renters for their properties in the areas that we desired. And then what we did is we had her do cold calling every day. So we created a script. So she would do, anywhere between 40 and 80 calls a day, right? And telling, calling them saying, hey, is this XYZ property available in this city? This is what we do, yada, yada, yada. And then we'd get, it's a typical funnel. We'd get rejections, but we'd get some yeses. And then from those yeses, what we did is we tried to establish a deep relationship with them. Oftentimes they were property managers. The huge upside when you're doing asset heavy is that property managers love you, right? Because you're basically doing their job and helping them fill their units without really, any work on their part, right? So we built these kind of deeper relationships with these property managers. And eventually what happened is they kind of became they became feeders. So they just, when they had units that were available, they just dropped it to us. Hey, Kendrick, hey, Shiv, like we have this unit available. We said, okay, yes. And that kind of helped us scale that way.
Yeah, you found the golden goose, and that's
Exactly,
that's awesome. And I saw you're in quite a few cities. You're in San Jose, San Bruno, Daly City, San Francisco, Palo Alto, all these different cities. Why did you expand operations to so many? And when did that happen? Did you keep everything close by initially, or after you had the VA funnel, you just were reaching out to anywhere that basically said that they're offering their property to you guys?
Yeah. So the Bay Area is a little bit unique in the sense that there's a lot of cities compiled in 1 hour of driving, depending on traffic, 50 or 60 miles. So a lot of those cities are in that region. But we do have some cities that are out of California. We have some in Reno. We're looking in Nashville right now. The idea was, they were relatively close. But I think to answer more of your question, the idea is, we want to be kind of location agnostic in the sense that we want to be able to build a system so that we can be opportunistic, right? If I go to a conference and meet someone in Philadelphia and they tell me that they have a 35 unit apartment complex that they want to do short-term rentals on, I want to be able to leverage that opportunity and set up shop there so I can capitalize on those 35 units. So the idea is, we're kind of trying to be location agnostic. We're trying to build our system so that we can tackle markets and see opportunities and take hold of them when they come.
So you get to 15 units, and at that point, where you I imagine that you were pretty profitable. Were you getting how much were you getting per unit at that point?
So what we found our niche to be is kind of bigger units. We noticed that the way it works in pricing, at least in our experience, was when you look at a 1-bedroom versus a 2-bedroom, right? The difference between a 1-bedroom, renting a 1-bedroom for a long-term lease, that difference is outweighed by the profitability that you can get when you're Airbnb it. So let me explain through numbers, right? Let's say I'm renting a 1-bedroom for $2,500, right? These are, by the way, Bay Area prices for anyone not in the Bay Area. You're renting a 1-bedroom for $2,500, right? If you, for long-term, let's say a 1-year lease. If you rent a 2-bedroom, it'll maybe cost $2,800, $2,900, right? So that $300 or $400 difference that we would pay in rent would be completely outweighed by the Airbnb or short-term rental profitability, right? A 2-bedroom is way more profitable. You can also think about it as there's no hotel product that necessarily can compare to that, right? One bedroom is still a hotel room, whatever, but a two bedroom is a completely different product. So we started moving into two bedrooms. We were looking at, $1,000, $1,500. Sometimes in our bigger houses, we were doubling rent. So we got $4,000, $5,000 a month. So yeah, it kind of spread, but on average, maybe $1,500 per unit.
So I mean, you guys are making some pretty decent money. 15 units. I mean, that's definitely enough for two guys that just graduated college to kind of cruise by. What changed? Because you guys are actually the first on our show, and one of the first people that I've heard of that we're talking to that decided to go investor route and actually sell a portion of your company to acquire some more capital. Is it just because you guys are from the California area that it's just like, okay, we got to do the tech startup thing, got to sell our company, but what made that switch so that you need a?
Yeah, no, it's a great.
Because you could have scaled this, using your own capital, but you decided to take a different approach, and I'm curious as to the reasoning behind that.
Yeah, I mean, it's a great question. So the logic was when we set out to do this whole thing, right? We met at a country club. I think it was like December 25th or 28th, 2018, right? And Kendrick and I we'd go to these country clubs, and we're not members of them. We just kind of walk in and just like figure out, sit in a nice view and have this like, end of year business meeting and plan for the next year, right? So we set out in that plan to chalk out what we wanted to do in 2019, right? Some of our goals were to get to 20 units by the end of the year, to have, discounted cash flow of 300,000 for 2020. These were our goals, right? So when we started getting pretty close to that relatively quickly, I think we kind of realized that at the end of the day, like, we're pretty ambitious people, and it wasn't necessarily about the money. Initially, we thought it was okay, like the whole financial freedom thing is great, right? We were doing this whole thing, by the way, while we had a job. So when we had the option to leave our jobs and kind of take a salary, it was great. But I think we kind of just got there faster than we thought, and we didn't necessarily want to stop there because we were enjoying the process. Someone told me this analogy a while ago about the road to Hana. There's a story where his friend, this guy's friend, was in Hana, and he asked a local person, "How do I get to Hana?" And the person told him, and the person said, "Make sure you get there before sunset." Right? So he and his family, they're driving up the road to Hana, and they're driving really fast, and they're trying to get there before sunset. And they get there, and they kind of are just looking around, and they're like, wait, what's so different about it? And they go back down and they talk to the person who told them to get there before sunset. And he said that the whole point of going up the road to Hana was not the end destination. It was kind of the road itself, right? On the journey. So I think for me and for Kendrick, it's really about the journey for us. So we just wanted to continue the journey. I think if we just didn't raise money, we kind of grew slowly, it wouldn't be as exciting. So we thought we'd just raise money and play out this journey and kind of enjoy the experience and see where it goes.
Now, do you connect with a lot of hosts, or are you guys kind of in? Because I imagine that it's got to be pretty different with when you are having an investor client, fund you. Are there different types of relationships or different types of ways that you have to operate having an investor partner when you do sell? And just to give a little bit of pre-context, are you allowed to share how much you received to start funding into properties and how much you gave up of your company for that?
Yeah, I wouldn't be able to share how much we gave up, but we raised about 800,000. But yeah, in the sense it's different, because you're more accountable, for sure, right? You now have investors that you have to make sure you're returning. But I don't necessarily see that as a bad thing. I think we got lucky again with the investors that we're working with. They're very, very laid back, and they kind of understand that we're closest to the business and we can make the decisions that we need. In terms of how you operate, I think it really depends on the situation with the investor, right? You have your term sheet and you define what the terms are. For us, it was very lenient in the sense that a lot of the big decisions we're still in control of. And we have a very good working relationship with our investors. So We have weekly meetings. We make sure that we're on track. It just adds that layer of accountability, which I think is beneficial in the long run. So, yeah.
And what does business look like when you just kind of have all this money that's kind of given to you to be able to expand as much as really you want? I mean, 800,000 in this business. If you were setting up a unit for 7,000, 800,000, you could do quite a few units.
Right.
What does it look like when you have all of that? How you're going to be operating moving forward?
Yeah. So that's kind of where we're transitioning our new. Maybe it's a good time to talk about what we're trying to do now. We were doing a lot of asset heavy, which is signing master leases, paying for the furniture. I think where we're transitioning to right now is, we obviously have this chunk of change that we need to figure out how to deploy most intelligently, right? So the idea now is we're thinking about, for economies of scale, looking at going and approaching apartment complexes, then also doing asset light, basically management fees, right? The idea being, one, it's a lot easier to scale when you can work with apartment complexes, right? Because if you have a 50 unit apartment complex, we tell them that they're making X dollars a month on long term rent. We can give you 1.4x because of the short term rentals, yada yada. We'll manage it for you, etc. It'll help us scale a lot more fast. But the twist that we're trying to do right now and we're playing with is, how do we hybridize both the multifamily syndication world with short-term rentals, right? The way we see it right now is short-term rentals is kind of, the new age way of doing real estate, correct? When you can make money on real estate without owning real estate. 30, 40 years ago, that was never the case. Multifamily syndication, a lot of the players there are more traditional in their thoughts. So they're doing traditional, they're buying buildings, they're renovating, increasing the rents, but also still doing long-term rentals, right? And when you look at valuing commercial properties, the way they're traditionally valued is, how much income is this asset producing? Depending on how much income that asset is producing, that's what the sales price will be, right? So our idea is, if we've unlocked a way to take rents in the Bay Area where, they're some of the highest in the world, and make money off that. What happens when we go and find these apartment complexes, convert them, so raise money, do multifamily syndications, and convert these, instead of being long-term rentals, to short-term rentals? How does that play out for the return on investment for the investors? So that's kind of the idea, and I think it's kind of an untapped opportunity that a lot of people haven't figured out yet, because there's not yet a player that can do both.
You left college, you were trying to get into real estate, and then a year later you have over 32 properties, and now you have investors, and you're about to start doing multifamily short-term rental syndication. Did you have a whole lot of I mean, that's quite the growth curve. Are you just kind of learning as you go, or did you have someone that was helping you all along the way? Because it's quite impressive, and it's also a lot of responsibility, to be working with this much.
It's a good question. I think the answer is that you can ask, Elon Musk, you can ask all those guys. I'm nowhere near comparing myself to them, obviously. What I'm trying to say is that people just learn along the way. They probably don't have it completely figured out. I think for us, we didn't have anyone besides the internet to help us. And I think this is a very important point that people do need to understand, that there's so much information out there. Julian, your podcast, like other people's podcasts, blogs, websites, just absorbing all that information. And I think the biggest difference for us is we were religious about taking action, right? There's so many smart, creative people that I worked with in my previous company, people that I went to school with, that were a lot smarter than me. But I think the biggest difference is we were religious and obsessive about taking action, right? Setting goals for the year, and being obsessive about getting after it, and making sure that we set this goal and we accomplished it, right? So I think, to answer your question, we use the internet to help us, right? There was a lot of resources there, and I think, like I said, it's more part of the journey. So I think the way we're looking at it is let's just keep setting goals and keep getting after it, and making sure that we're enjoying the process. but yeah, it is a lot of responsibility. And I think, I'm happy that we're younger and we don't have family. We don't have, kids to kind of risk. So that's why we're trying to be aggressive right now to see where it goes.
I'm definitely curious in the multifamily syndication with the short-term rental spin to it. A lot of people in that syndication mindset, it's almost like real estate, but at the same time, it's also not. They're very business oriented, very suit and tie. It seems like they're very numbers driven with a lot of the real estate and the short-term rental world. It's almost kind of like the Wild West, where it's like people are really slinging deals and trying to make a couple $100 here and there. So to see where you guys go with this pivot or with this move would be interesting. But I also want to hit on something that you talked about before, which sounded more similar to like Sonder lyric style. Was that the approach that you were going with when you initially got that VC capital, that you were going to be going more the I guess you could say traditional route with apartment complexes and furnishing them that way?
Exactly. Yeah. That was our original pitch. We were like, okay, well, obviously the unit economics of what we're doing is very strong, right? We had a track record of 15 units and our growth curve, et cetera. So we pitched all the numbers and the numerics. And that's what we were going to do, right? Is, traditionally go, and work with owners of apartments and master lease and absorb and build the brand that way. But I think what we realized is that there was so much upside to be capitalized when you actually own real estate that we weren't capitalizing on. And we didn't see a lot of people in the multifamily space doing either, right? They would traditionally maybe do some multifamily syndications and maybe make 5 or 10% of their units short term or corporate. But since we're becoming masters at this, why not take this idea? Because the reality is, if we're doing multifamily syndication and we're doing short term rentals, the returns for our investors would far outweigh than traditional multifamily syndication, just because of the economics of short-term rentals, right? If a traditional short multifamily syndicator is doing long-term rentals and getting X, we will just get 1.3x or 1.4x, even 1.7x. And how does that translate to investor return on their money? So I think, we really see a lot of opportunity in merging these worlds. We're always looking for investors, and that's kind of how our approach is going to be moving forward.
I kind of see a couple pivotal moments. One of them being when you had those your first couple of units, you're starting to make money, but then after that, you realize you need a little bit of capital a little bit quicker if you wanted to be able to scale, the way that you did. So you started raising money from friends and family. How do you present something like that? Maybe there's a lot of listeners on the show that would like to be able to scale a little bit quicker, but they want to get other people involved to raise that initial capital. You said you raised around $80,000 from friends and family. What does that look like when you are pitching to doing that initial round of funding?
Yeah, so we did a lot of we did it very bite sized. We didn't ask for 80,000 all at once. We kind of did it in bite sizes, right? I think the approach we took, just because of our personalities, is we were very metrics driven, very numbers driven. I think, any investor in the reality cares about the return they're going to get on their investment, right? And the only way you can show them is by proving out numbers, right? So we really went over, okay, this is how we're doing so far with the money we put in. This is where it's kind of translating to. This is our projections of how it's going to look. If you give us this much money, this is how we think we're going to do in our business. And this is why we think we can guarantee you an 8, 10, 12% return on your money, right? I think there's a bunch of ways to do it, right? You don't necessarily have to do it where you're taking this money and guaranteeing someone 8, 10, 12%. You can also take the money and kind of do equity splits on a small scale, right? You can take a deal and say, I'll do all the work. Maybe I'll get 10% of the profit. You just put in the money, something like that, right? I don't necessarily advise someone who's not completely confident or sure of what they're doing. I would honestly advise trying the co-host way, right? Because that's almost like a financially less risky way of building out proof of concept. I think the way it works, at least in Silicon Valley, is like it's very proof of concept driven, right? If you can build out your proof of concept and show someone what you're doing is working, then it's kind of easy to scale that way. So maybe your strategy would be, build out a proof of concept doing co-host, not having to put up all the money or being financially liable. and then kind of building your systems and tractions, and then maybe moving on to master lease. There's pros and cons to both. I don't necessarily recommend one or the other. I think it's very situational. So whatever situation you're in and opportunity you think is stronger, I would leverage that.
So you were basically guaranteeing your friends and family the return on their investment with a 8% or 12% yield on that as well?
Right, exactly. So if they gave us, $10,000, we would promise them 8% return annually, basically. Yeah.
Okay, so this was a long term play for them. This wasn't just a quick. They hand you the money and then you give them back a certain percentage more, and then that's the end of the relationship. It was more of a percentage stake.
No, we were thinking, like, let's say if they gave us 10,000, we would try to pay. I think one of the strategies we did, we would try to pay it back as fast as possible, right? So throughout this whole process, I haven't, nor Kendrick has taken any money out for us, right? Everything that we were getting was reinvested into the business or reinvested to pay off our investors. I think their hold, they were thinking maybe a year, 2 years. I mean, we paid off a lot of it right now. But yeah, it wasn't necessarily like a royalty model or anything like that where they would continue to get dividends. Although, if you're just starting out and that's the only way you can start out, I would recommend it.
I think it's super interesting. And I talk to a lot of people and they say, oh, I like, because there's so many different ways that you can play in this space. Like one of the ways that you were saying that almost sounded very similar to what we're doing is, with this, through co-host that we're offering this turnkey rental arbitrage is what we call it. Our turnkey arbitrage program where investors can fund us and we'll go and basically fill occupancy in units that we're already operating in. There's all these unique twists in this business that are just nobody have thought of, and you can be creative. This is the Wild West right now for these entrepreneurs, and it's super exciting talking to you, Shiv, because you went from a couple of units to now you're going the more traditional Silicon Valley route, raising your initial round A, your round A funding from your friends and family, and then you get the VC back, and now you're doing something completely different, almost moving into a space that is really untouched. For the people that are looking to be able to scale quickly, though, I guess the question would be: could you have scaled to where you are now if you didn't raise that initial capital, or you didn't get that second round of funding, or is it just maybe not possible to be able to scale to, let's say, 32 properties in about a year?
No, I think it is possible. I think, in our situation, this was kind of the best move to make, given our circumstance, our opportunities. But I think, obviously, if you're going to do, signing master leases, money needs to come from somewhere. But I think, co-hosting or property management is easily doable. I'm working with a few guys in the Bay Area, I know who've grown in the past few months to 10 properties. And they're doing all property management co-hosts where they've kind of tapped in a real estate agent network and are getting property managers to refer them and kind of building it that way. I think it's definitely doable. I mean, the one advice I would give everyone is when we started out, one of the problems was we kind of would it's good to be receptive and to be open-minded. But sometimes what we would do is we'd hear someone who was supposedly an expert, and then kind of just assume that they knew everything or their way was the best. And I think the message I'm trying to communicate is what you guys are going to hear on this podcast and other podcasts are all good information, but you need to really understand what your situation is, right? Like where your upsides are, right? We were kind of from this area. We had built this network that we could leverage that. Maybe I wouldn't have heard this whole strategy of raising money on a podcast because most people are like, you have to go to, 100 investors, 200 investors and talk to them. We decided to spend like a year building this relationship with him, having, Kendrick work with him as a property manager and kind of deepen the relationship and kind of guide him through that and eventually request to raise money. But, in your situation, it may be something different, right? You may have worked in a property management company and you could contact all those property managers and tell them about your business, right? So you really have to understand where your upsides are and where your opportunities are. It's sometimes hard to see, but I think that the differentiation between someone who who is good and someone who's great is really the ability to identify opportunity. It's not that one person has more opportunity than the other. It's how able are you to see the opportunity.
What has been the most challenging part of scaling your short-term rental business?
Yeah, so we're at 31 properties right now. We have a pretty aggressive goal. We're looking to get to about 250 properties by the end of the year, right? So we have basically a 10x plan. Right now, our biggest hurdle is kind of figuring out what market that's going to be in, what market that's going to be in. We're kind of moving away from California just because California is not necessarily the most landlord friendly place. There's a lot of regulations, etc. So we do corporate rentals, which is 30 plus stays in places that have regulation. But I think the biggest challenge is finding the market, and then kind of understanding. I think there's a trade-off between growing too fast and dropping operations, and prioritizing operations and not growing too fast. What I mean by that is if you dedicate all your efforts to sales and business development, you could grow exceptionally fast, but then do you have the operational capacity to handle that growth? So I think understanding that balance, and then figuring out what market we're going to kind of dedicate our financial and human resources.
When you're talking about scaling a team, you started off with the one VA who was your salesperson, which seemed like it did a really good job because then it opened the doors to a lot more of those golden gooses. But now you have 4 VAs, which is still a pretty lean team, and you guys have basically the opportunity to grow this exponentially more. What's your strategy with your VAs and your team and how you're building that out?
So we're very technology driven. We use a lot of technology. We try to make our company. Our company is all virtual, right? So we have people in the Philippines. We have some people in India. I'm in California. Kendrick's in Washington right now. So we're all virtual. We built this whole thing virtually. I think what we try to do is make sure that we're using technology to run very efficiently, right? So we use Slack. I mean, I'm sure you guys know Slack. We also have a lot of Slack apps. So one of the apps we use is called Geek. That basically allows us to do daily stand-up calls with our team virtually. So every day, this Geekbot app requests from all our team members what their agenda is for that day. What's the one thing they can do that can yield the most value for that day? Then what else are they going to do? Did they complete their one thing that they said they would do yesterday? And then are there any blockers, right? So we can kind of go in now. If I go to Slack, I can see everyone's report, and it kind of helps them plan their day too. So we leverage tools like that. We have another tool called Office Vibe, which I recommend when you're growing a team. It kind of helps you understand employee engagement. So it's kind of an anonymous feedback tool, which allows all our team members to give feedback very honestly, right? So I can actually get I can get a clear understanding of the health of our company. So I think using tools like this, understanding the well-being of your employees is very important, and making sure they're working efficiently and empowering them. I think the other big thing is when you're building a team, you really have to be obsessive about understanding where people's strengths are and where to place them, right? You may hire someone for one thing, but you may notice that this person is way better a communicator than they are a guest messenger. They're better on the phone. Okay, so maybe we'll take this person and put them in a sales position. Or this person is really hospitable and very good at writing and messaging, so let's put them here. Or this person is very good with numbers. I'm going to have them own pricing. So kind of being obsessive about understanding strengths and weaknesses, and then organizing your team to maximize the value.
I think it's super interesting, Shiv. I love talking to the hosts that come onto the show because what I've noticed though is that a lot of the engineers, the people that are tech savvy, they are very lean and mean. My partner John, John Bell, who runs co-host, he has about 35 properties or so. He also is a super lean team. Yeah, I think he has like one assistant, and everything else is like automated. Like it's just like crazy because a lot of this stuff can be fully automated. How I'm curious. I wanted to know though, what are you doing with your VAs? Like, what are the roles of the people that you're adding on, and where do you see those roles going?
Initially, we have four right now. We just hired our fourth person recently. Initially, what we were doing that was actually affecting our ability to hold accountability within our team was we were kind of grouping them all as a team, and reaching out to them when we had something that we needed to be done. But the problem with this was we were treating them as kind of one group. So when we wanted something, when we wanted to work on something, there wouldn't be clear accountability and ownership, right? And I think this is also a very important thing to note for people is when you're building a team, accountability and ownership is super important, right? When we work on something and we request something to get done, the likelihood of it getting done, if I say like, let's have a calendar, let's have a meeting next week to talk about it, and I put it on the calendar, now everyone's accountable. It's way more likely. So yeah, it just, we have one person who's focusing on kind of our listing management. So making sure all the details are correct, watching the pricing. So making sure pricing is correct. Now that we're kind of approaching it with different buildings and units, we have people owning certain areas, certain buildings. So we have a new building in Reno that we're actually picking up. And we have one of our team members kind of owning that building. And then we have someone owning sales. So another thing that we've recently done is leveraged this EOS. Have you heard of Entrepreneurial Operating System? It's by this book Traction by Gino Wickman. Was super helpful for us to just kind of organize our systems and frameworks. So now what we're doing in our company is we're being even more metrics driven, where we're giving everyone a role in their company and then helping them choose their quarterly goals, and then having a metrics Monday meeting every Monday to see how we're faring for that quantitative goal. So it's very systems driven. So for example, Kendrick's goal is 40 units, new units by the end of Q1, right? So if his goal is 40 new units, maybe he needs to network with 5 strong potential leads that have an 80-90% likelihood, right? So his goal is five every week, right? So every Monday we have this meeting, and he'll input how many leads he met, and then we'll discuss saying, okay, well, why was it less? Why was it more? What could we do to get better? Mine is like occupancy, right, and pricing. So our goal was, I think, 80 or 90% occupancy in Q1. So every week we have a review saying, okay, we were at this occupancy. Why were we lower? Why were we higher, etc. And then every team member has their own metric that they own, and then we kind of walk through that every week to help making sure we're all on track.
So you said, one person's more for the listing management. You said one person manages more of the pricing.
Yeah, so one person's listing management, pricing, and then the other person is cleaning. Kind of owning our cleaning.
The cleaning, and that's going to be a lot of cleaning. You have a bunch of different cities. Are they basically running the whole cleaning operation? You have like a cleaning funnel. Cleaners is one of the most sticky things in this business. It's sticky because it can get sticky. But it is also very challenging to find reliable cleaners. What does that operation look like when you're scaled out across multiple areas?
So our approach there is, again, trying to find smaller companies, smaller vendors. We don't necessarily like working with bigger vendors, just because we notice that when we partner with a small business cleaning team, and we kind of present them with the opportunity of our growth plan and what we're looking to do, they get more excited about the opportunity and they take more ownership. So we've been very fortunate enough to have found a very good small business cleaning team that has kind of targeted our whole, Bay Area region. So they've been very helpful with us. We have this tool called Properly. I'm sure you've heard of it, to kind of track cleaning quality and everything. So we partnered with one vendor. We do calendar sharing. We cross-reference with Properly, etc.
What does your role look like when you first started to where you are now? Now that you have these dedicated people that are able to work on some of the other aspects of the business, what does you and your partner's role look like at this point?
So when we first started, we were working a lot, in the business. You guys must have heard that phrase of working in the business versus working on the business. We've fortunately moved out of a lot of the guest operation issues. So, now I don't really know what's going on too much on a day to day. What we're really doing right now is focusing on our goal, right, of 250 units this year, out of which we want to own 100 of them. So 100 out of the 250 is going to be the multifamily play. So our role right now is, networking with investors, kind of pitching our product, strategy. So choosing the markets where we want to grow. And then, from a high level, I'm still kind of overshadowing pricing, just because if your pricing isn't correct, nothing really matters. At the end of the day, you can't sustain your business. So yeah, it's more working on the business, the strategy, business development, sales, networking, and then pricing.
So with 4 people, you're able to at this point completely basically walk away from knowing the day-to-day operations, and you're still able to, run a profitable business.
Yeah, right now it's kind of like that. Yeah. So, I mean, technically at this point, if we wanted to, I think we could just step out and not work on the business and kind of let it run, because we've created all these, systems and procedures and standard operating procedures that I think the team would have enough oversight to manage. Yeah, I think at this point we're pretty much, yeah.
And what is your build out process I mean, you're planning on scaling really quickly, taking on a lot of units. What does building out look like? Are you going to the units and putting all the furniture together, or what does that look like?
Since we're going to be approaching different cities, the idea is we hopefully can work with some furnishing companies to kind of that already understand this operation nationwide. But yeah, orchestrating the onboarding process is actually, I just had a call with Kendrick this morning about how we're going to operationalize and systematize that process, right? Because when you're going to go to, let's say, Nashville and open up 30 units, and then Atlanta open up 20 units, you're having 30 units of furniture, right? So how do you kind of systematize that? That's really what we're figuring out right now. I think it's going to be a bunch of like ownership and checklists. And if we're going to do it ourselves, we're thinking about maybe hiring like a logistics coordinator that kind of gets deployed to these markets to set up shop. There. But, as of now, we're still kind of figuring out whether we want to outsource it to an established company that understands nationwide operations, or just hire internally like a logistics coordinator who can fly to these markets and expand and open up shop.
You've been keeping everything pretty close to home for you right now. Have you been building out up to the 32 units, or has most of this been outsourced?
Yeah, no, that's all been outsourced. I haven't seen a lot of the units actually. Because I do operation, I do more of the systems. Kendrick was doing business development sales. I think he's only seen maybe 60 or 70%. I haven't seen a lot of them. So we've really like systematized it. We found someone that we've been working with for the past year, kind of trained him. So he takes ownership. I think the biggest thing is we want to make sure that we're allowing people to take ownership, so we can delegate something, then we can elevate ourselves to the next thing that needs attention. So a business is very centralized around ownership. So the guy we were working with, he's kind of owning this whole process and understands it. So he knows what to do when we get a unit. Our cleaning team knows what to do. Everyone just kind of owns their piece, and it just like flows like that. So yeah, I haven't seen a lot of them.
How do you create that relationship with these types of people? Because when you say ownership, you're not like giving a percentage of the company, I imagine.
No.
When you say ownership, what do you mean?
Ownership, in terms of responsibility, I think just encouraging people to kind of, we're not giving them a percentage of the company, but I think what they are getting is kind of an opportunity to see this company from nothing. I mean, it is very exciting. Like our first employee, Karen, joined. Well, it's been almost a year since she's joined, and she saw us when it was me and Kendrick like going and staying up all night furnishing apartments, to now we have systems and people to support us. I think it's making sure that people actually like what they're doing, and they're happy. So I think what we tried to do with this office vibe tool and tools is encourage like transparency, because sometimes, depending on culture, some people are not necessarily open to like giving feedback and actually sharing how they feel. So office vibe, this app helps us kind of eliminate that friction between what people actually feel and create that transparency. So I get a lot of feedback there. So I get feedback, saying like, this week's been really hard. The stress levels have gone up. Health, I feel like, there's too much going on and we're not able to handle it. So I'll make sure that I address that, or, other concerns. So I think really being there for people, letting them know that you're actually listening and you want feedback. I think lets people kind of give them ownership and feel excited about their job and kind of own it. Yeah.
Shiv, I'm sure that we could just keep on talking for quite a few hours, but I want to follow your progress. I think it's super interesting. There's certain people that are doing some really unique stuff, and you're one of those people that I think it's really cool. I think it's really cool to see your progress on where you're taking this, because you are taking a pretty unique approach. So I do want to get you back on the show. Maybe a few months down the line, we'll see where you're at and your processes. But super interesting. Definitely want to know more. One last question that I do want to ask though is what's in the space in the VC venture-backed space for the short-term rental economy? Is there a lot of noise or interest from people that are looking to invest into this, or is it still pretty new for the people maybe that are feeling like maybe I missed the boat, or maybe it's too late to start my own rental arbitrage or co-hosting business? Coming from your background and from just where you are in the Silicon Valley, a lot of money, a lot of people there. What is the I guess the overall consensus with this new market?
Yeah, I think there's a lot of excitement. I mean, you can see that the way companies have just been popping up recently, right? Sonder's been there from a while, but there's a bunch of companies. Wanderjohn is backed by Coastal Ventures. There are a lot of companies popping up. I think the interesting thing is when you're going that route, and we didn't necessarily go that route fully. We kind of are in the middle. But when you're going that route, and you see these VC companies very interested, there's something up. I think if you just look at it from like the perspective, because some people when we talked to them about our idea, they were like, you're not. How are you different from this company that's doing it, or that company that's doing it? Which is a valid point to some degree if you want to be the best in the world at it, right? If you want to be the biggest and the best, then the question of how are you different is very relevant. I think taking it smaller to people who want to start their own rental arbitrage business and have, 10 units, 20 units, 30 units. I think there's more than enough space, right? If you think about it, how many rooms does Marriott alone have? Hotel rooms, right? Did they say, oh, we shouldn't build any more hotels, because we already have, this many and we don't know if people are going to want it? I mean, the reality is it's a function of supply and demand. You can see growth in demand for Airbnb and short-term rental type products. And, all you need to understand is if there's a growth in demand, there needs to be a growth in supply to fulfill that demand. So I think the market is definitely open to having 10, 20, 30 units on a small level. And then of course, if you find the right market, I think on a large level as well.
Wow. There's so many good takeaways from the show. I highly encourage anybody that is, interested in scaling a business, definitely get a listen to this. It's going to be interesting because I'm sure that your operations and how you're going to be using your team and the tools is going to completely change in the next 6 months to a year. So got to get you back on, Shiv. Thank you so much for coming on the show. Is there any way that anybody wanted to reach you if they had any other questions? I know that you have some stuff going on as well with your syndication deals. If anybody does have any questions, what's the best way to get in contact?
Yeah, totally. Yeah, we're always looking to raise money and kind of get people excited about this opportunity that we have presented. You can reach me at shiv@experienceastro.com. So that's my first name and then Experience Astro. I'm sure Julian will provide in the show notes. And then you could also get us on our website at experienceastro.com.
Experience Astro. Okay, definitely. I'll include everything in the show notes. Thank you so much, Shiv, for coming on the show. And until next time, Host Nation, keep on hosting. Hope you hosts benefited from the show. If you found value, please go on over to iTunes, leave us a review, and let us know what you enjoy about the show. If you'd like to talk to hosts that have been featured in these episodes as well as the community, go on over to our Facebook group, The Host Nation.